What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
Today I'm joined with Eric, and is it Bonick? Is that how you pronounce your last name?
Yeah, it is.
Sweet, awesome. And how you doing today, Eric?
I'm doing pretty well. I'm excited.
Excellent, excellent. And I got some great news for you, Eric. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate investors, syndicators, deal sponsors, buyers, sellers, all that kind of stuff. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of an off-market deal, the private deals that you're not allowed to publicly discuss, then you might know that the SEC requires that you have a documented prior substantive relationship, or else they'll get ants in their pants. And that's something we definitely don't want. So it's important to have people on here find out where their focus is, what they're really all about. And the benefit to you is you'll learn how to more effectively communicate on the subject of commercial real estate deals. But before we get too deep into real estate, Eric, do you want to say a thing or two about yourself?
Yeah, so my name is Eric Bonick. I am running a fund. We established that in about 2019. Oh, sorry, excuse me. I moved to the area where the fund is, which is Albuquerque, in 2019. We started picking up assets out there in 2021, did a full fund conversion in 2023, and now we're expanding into the Denver market and hopefully Tucson.
All right. Awesome. Awesome. I love it. And the first segment that we always do here in the Chance Encounters, it's the 5 distinct motivations. Before that, I got to say, but wait, check your 8. And I know that you're an airman, so this may be more difficult, might be less difficult. I don't know. But maybe you have the ability to see through the camera and down at your 8 o'clock. It's the audience is 5. And there might be this hideous subscribe button. And maybe they should, do something about, okay, it's a corny joke, but I do it in every episode because hey, you miss 100% of the shots you don't take, right?
Fair.
But the 5 distinct motivations. I've now spoken to hundreds and hundreds, possibly even thousands of commercial real estate players, and everybody has their own unique why. And it's really important for people in this industry to know what that is, because it tells you whether or not somebody is going to throw in the towel when the going gets tough. Because after all, these deals take months to close. They take years to go full cycle. But at the end of the day, I found that they do pretty neatly fit into these 5 different categories. And so I go through all of them in every episode. The first one of which is preservation of purchasing power. What's that? Well, some people, they don't have to have a job. They're W-2 optional. They don't really need to work. And the reason why is because they rely on the proceeds of ownership to pay their bills. So that means that they don't have to, find some other way to earn their money. And the question you might ask is, if somebody's in that situation, why would they go through the hassle of another acquisition? And there's 2 main categories for that. The first one is, if inflation is rearing its ugly head, it's pretty clear that it's going to be time to make another acquisition, because that's going to eat away from the purchasing power of your cash flow. So it's going to be very important to have that happen. But the other time is that if you can buy a distressed property, or if there's an asset crash or something, you can buy at a steep discount, which is of course what everybody should be doing. But at the end of the day, that is the other motivation, where somebody in that situation will make the jump and make another acquisition. And full disclosure, I'm not that far in my real estate journey yet, and it sure would be nice to be in that situation. But where I'm at is trading time directly for wealth. If you ever become a high wage, high salary earner, then one thing you're probably going to end up noticing is you pay more in tax than anybody else. You've got the highest tax burden out there, including people who are far wealthier than you are. And me personally, I came from the tech sector. So it was specifically CRMs, the mass marketing. So emailing 5 to 7 million emails a month, doing hundreds of thousands of dollars in sales in a single weekend, and millions over the course of the years. But the thing for me is, as I was doing that, I eventually started doing it for a guy who was flipping 10 houses a month, like clockwork, for years before he hired me. And I saw him making money hand over fist. And it hit me, well, how can I pivot to where I'm getting rewarded in these little slivers of deployed capital, AKA equity, instead of constantly trying to increase my salary? So that's how I got into this. And of course, for a lot of youngsters, that's a little bit too abstract. I know that Eric is definitely in the minority after our brief conversation in Phoenix, that, I'm sure that that's part of his play. But a lot more youngsters, they tend to want to hustle like crazy right now so that they can retire sooner. And maybe that actually means that they just want to take control of their schedule, which is something you don't really have when you have a W-2. And it means working fewer months per year or fewer weeks per month, something like that. And that's what they're all about. But the thing to keep in mind, a lot of people who have this as their main motivation, they think it's secretly everybody's motivation, but I assure you that is simply not the case. For example, there are some people that are just plain ambitious. They want to buy their entire hometown. They're after that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. And even though that is vilified in some circles, the fact is you need people who are going to stick around and keep hustling as part of your partnership. So that's fantastic to have them as part of your team. But the last group, they aren't so much about their own generational wealth, but they've picked a sector of society, or maybe it's the environment or animals, who knows what it is. But if you want to make a really big impact, there's a financial component to it. And that's why some people end up making their commercial real estate acquisitions. So Eric, I think I got a pretty good idea where your motivation stands, but I don't want to put words in your mouth. What combination of those would you say describes you best?
So I mean, the motivation for starting what I created here was to give people access to an investment vehicle traditionally exclusive to those people who already had a ton of money, right? Like, I mean, me and my friends, my family, I mean, I didn't come from wealth. I mean, we were barely making it by. A lot of times I lived with my grandparents, parents were divorced, pretty common for a lot of other folks out there. And after I started going to college, talking to other people who did have generational wealth and understanding that it could be very powerful and life-changing, it was like, how do I get there? And how do I help other people get there? And that was kind of what was like the start of this. Like I started investing in real estate in 2016, just with like a single family home on a VA loan. And then I house hacked it with roommates. And then that just grew and grew and grew from there because my friends started asking, like, you're making so much money in real estate. How do we join you? And then it was kind of just figured it out of how to create this fund and grow it from there and then continue to expand it for years to come.
I love that answer. And of course, one of the issues, though, is that when we're talking about motivation, it's pretty easy to sound overly optimistic. And, the fact is, there are risks involved in every type of business, and real estate's no different, and commercial real estate as well. But if you've ever been involved in a private deal, one of these off market 506B syndications, then whoever the securities attorney in the mix was, and there better have been a securities attorney, or else you should run. You shouldn't just walk. You should get out of there. But the securities attorney should have insisted that everybody involved fills out this really invasive financial questionnaire. Some people call it a suitability questionnaire. It's got all kinds of questions about your net worth and things like that. And admittedly, that's the format of this interview, is to try and get that without being so invasive. But one question in particular on that questionnaire, I thought it lacked utility. I thought that it didn't really give usable answers, and it was the tolerance for risk assessment question. So I made my own version, which is a fill in the blanks, and I think it tells a lot more. The question is, there are many popular investment asset classes, but I think blank is too risky. And we're happy to have an answer inside real estate, outside real estate, both if you really feel like it. But what's too risky for you, Eric?
NFTs and digital real estate was kind of blowing up for a little bit. I did it. Yeah, I thought I was like, yeah, that was way too risky. There is too many unknowns, too many variables, no control, no oversight, no um tangibility behind it. And I was like, that I'm not going to do that. If other people want to do it, sure, whatever, but not me. No way.
I love it. And after all, it's an appreciation move, like full stop. Buy low, sell high, or lose. That's the
Oh
only
yeah.
play. You're not even offsetting any of the risk from cash flow or something like that. So yeah, I love that answer. And I know, at the risk of getting too mathematical or nerding out a little bit, as a matter of fact, this next segment here, I avoided this. I skipped this when I first started the first couple hundred chance encounters, but I brought it back because I realized that my avoidance was because I know that some people are in this industry and they're more like a public relations or marketing role. They're the pretty face,
Yeah.
something like that. And they're not going to be the people who want to do the deep dive into the spreadsheets and unlock the mysteries of that property and that business attached to it. But even if you are that front facing person who's not very mathematically inclined, you're still going to pick one or two different metrics as the ones to figure out if you're going to pursue that property or not. Even though other people who are underwriters, they're going to look at this list of deal metrics and say, like, what are you talking about? All of them are important. And for anybody in the audience who's just listening and not watching, I read out these different entries on here. It's not an exhaustive list, but it's not bad. Let's start off. The first one is cash on cash, then IRR, then cost per door, then NOI, which is net operating income, the going in cap rate, which really is talking about what's the difference between the going cap rate in that area versus what you're purchasing it for. Then we have the loan interest rate. It's especially important if you're going to be assuming a loan. Then there's occupancy, which is the inverse of vacancy, which means it's the same thing. The average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it, the difference between the market rents versus the in-place rents, the population growth where the property is located, so you have some baked-in appreciation there, the sponsor record, which is how many deals have gone full cycle, how many deals are on the go right now. We have waterfall, split, and exit strategy as the next one, which means what happens after your capital's been returned to you. Then there's DSCR, which is debt service coverage ratio, which means how much of the revenue from rents is going straight out the door just to pay for the loan. Now, once again, that's not exhaustive, so you're free to add another metric or two if you focus more on those. But what are your top three or something like that, Eric?
So when we're analyzing a deal for our fund, our investors are looking for a targeted about 10% dividend every year. So big thing for us is cash on cash, especially walking into the asset. What is that going to look like day one? And then how are we going to improve it to achieve the target IRR over the whole period? I mean, all these other metrics that you listed kind of just flow into how you even calculate some of these things that we look for. In terms of like waterfalls and splits, we do everything on a profit sharing. So it's just a 90-10 split with the LPGP. So that's not really something that we have to play around with. I know a lot of other syndications out there really focus in heavily on the splits to make the numbers work and incentivize the LPs and stuff like that. But we're really just honestly focused on how's the asset performing today when we buy it in? What are the things we have to do to improve it? How much is that going to cost? Where is that going to lead us in terms of a ROI perspective annually? And then what does that turn into the IRR over the whole period to hit our metrics?
I love that answer. I'm just gobbling it up like a delicious subscribe sandwich. I'm big on subtlety when it comes to these subscribe button requests. I
Very,
know.
very subtle.
Very
Very
subtle,
subtle.
exactly. You'd never guess. But anyway, that tells me it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And I go through all 6 sides in every episode because this really is the key piece in helping you learn how to more effectively communicate on the subject of commercial real estate deals. And if while I'm going through these, you go, wow, I really need me one of those. Well, the good news, it's absolutely free. You can go to dandoesdeals.com. There's this great big button you can click on and download and print it out. Then you can practice with your friends and family because I really do think your future in commercial real estate is going to hinge on your ability to effectively communicate on the subject of the deals, being able to see if the teams are complete and that sort of thing. So go ahead and do that. But I do have to confess, I committed the cardinal sin of marketing which is you should never ever give your freebie away without asking for some sort of contact information. But that's literally how important it is to me that you print these out and practice with it. I don't even ask for your email address so you can make that happen. But let's get started. The most visible person in a commercial real estate deal is a repositioner because they are acquisitions people. They're looking at hundreds of different properties. They're doing all sorts of different paperwork and underwriting and math. They're figuring out, is this property even making the amount of money that this seller slash broker claims it is? Because okay, the repositioner has to figure that all out, and they have to figure out how are they going to make it more profitable, finding that upside. And I'd say the most peculiar part of being a repositioner is that every repositioner has financier relations that they have to do. They have to have a wide network of lenders, people with capital, and these are the financiers are the people who they're not going to be dealing with residents. They're only going to be dealing with paper and money and the people who are running the place. That's what a financier is. But the reason why you have to have so many financiers in your network as a repositioner is because if you can secure cheaper money, in other words, a more advantageous loan, that goes straight to the profitability of the building. So that's why that networking is so important to these different repositioners. But of course, if you're talking about the building itself, most people think about operations as the most important part. You're making sure that those Benjamins don't go down the toilet. But of course, there's more to operations than just unclogging toilets and collecting rent and mowing lawns and shoveling snow if you live where I live. But the parts that I contribute to an operations team while I'm on a GP team, there are a couple of them. One is because of my digital background, any kind of web application, anything like that, I can button that up faster than even other web developers. But the bigger one to understand is in any type of real estate, the vacancy rate is the enemy. Okay, if you've got vacancy, even if you're like me and you go for bigger properties, 100 units or more, you might be outsourcing your property management to a third party, and the way that you'll run into trouble is if you just can't get those units filled. And if that's the case, see, somebody on the GP team really should have some serious marketing chops, and that's one of the things that I bring to my teams. But of course, there's only so much you can do with operations because it's such a mature industry. So frequently the repositioner will have to get a contractor team involved to upgrade the property, to make it a nicer place. The theory being that the next resident would be happy to pay more in rent than the previous one if the place is in fact nicer. But if only it were that simple. The fact is, you can spend endless amounts of money on contractors. You could go ahead and gold plate the toilets for all the good it's going to do because it's not going to return on the investment. But excuse me, if you were like me, you may have one particular issue. I don't know if you know about this, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because that will not be me. I'd still be stuck at an airport in an hour or two. So you need somebody who lives nearby, who can check in, make sure that those contractors aren't using subpar materials, make sure they're not dragging their heels, making sure that the operations team, they're not sloughing photos or giving false information and basically being lazy, that sort of thing, because we got to make sure that these residents are happy. But let's do a hypothetical. Let's say you decide to become a repositioner. So maybe you're an engineer or you're a physician or an attorney or something like that. And you get this idea in your head that, hey, I know how to buy a house. You put down your down payment and then you go to the bank and you ask for a loan. So maybe you and your friends could all, put in 100K each or something like that and buy that 350 unit apartment complex down the street. So you turn around to the financiers and say, hey, I want to buy that property right there. It's the low price of tens of millions of dollars. Do you have tens of millions of dollars you want to lend us? Well, the financier is going to have one question that I haven't answered yet. And if you're in a mentorship program or you have a guru or something like that, I encourage you to listen very carefully to this next part because they tend to gloss over it. The financiers, the banks and whatnot, are going to ask, who's your sponsor? Who's your KP? What's that all about? In order to be eligible for a commercial loan, somebody in the fold has to already own a similar asset. That way, the bank can turn around to their depositors, the people whose money they end up lending, and saying, oh, yeah, this person, they'll definitely not run this place into the ground because they already own a similar property. They know how to run these things. On top of that, though, you also need a certain amount of liquidity. And then for collateral, the GP team has to put up at least the amount of the loan. So you need a balance sheet of at least the amount of loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Eric, I know that you got a few different things on the go, especially the financier relations is a big part, but what pieces of the puzzle do you and your team tend to cover?
So actually, we cover a significant amount of that. So it's for the longest time, it's just be me and my other business partner, David, and we were handling the management, the acquisition, the underwriting, and then the disposition of it as well. So fortunately for us, we haven't been utilizing traditional financing because that model just hasn't been ideal for us, especially in this rate environment. We've opted to just buy things for cash or work directly with the seller and work out a term with them, which is much more favorable and a lot easier for everybody else. So I mean, yeah, honestly, within that cube, we're kind of doing it all except the capital raising piece and the marketing. We're getting some help with that on the outside and bringing in a couple people onto the team to assist with that. But property management, we're actually doing that in house because, like you said, it's really hard to find good vendors, and we've fired a bunch of them. Same with contractors. So we definitely bring the property management in house, but we do outsource the contractors and we vet them through referrals and then actually working with them over time. But if you do the job really great the first time, but you don't do it great the second time, we're still going to fire you, right? Like you gotta maintain performance and maintain quality.
I'm so happy that you say that. Like me being in a digital systems analysis position, I'm always looking for bottlenecks. And I've had this conversation with a fair number of syndicators, which is like, hey, you remember back in high school when everybody was saying, hey, what are you going to be when you grow up? How many of them said, oh, I really want to manage a multifamily property? Because I don't remember that many, so that just screams bottleneck. So I'm so happy to hear you say that. But let's move on to the deals themselves, what is typically called the buy box. When commercial real estate people are asking each other, hey, what you looking for? What's easier to say yes to? What's more difficult to say no to? We're really asking for three main things. First one's geography. Where is it? Which states? Which county, even possibly which neighborhood, okay? It's going to matter. So that geography is the first one. The second one is size. And if you think about multifamily, the way that they do size in apartment complexes is by the number of apartment units. And of course, that's part of the reason why people choose to invest in apartments instead of single family is because when you invest, you're basically divvying up your risk among multiple residents who are paying their rent instead of just a single one. But the way that you define that size, again, it's that apartment units. And the reason why it's important for real estate people to know how many units you're looking for is because the type of team that takes over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the ones who take over 100, 150, 350 unit apartment complexes. So that's going to matter. And of course, other forms of real estate may go off of acreage or square footage, but that mention of size is still going to be the same issue. So that's going to be important. Now, the third one is called class. I'm not crazy about the term class. I think it should be called desirability. And that's because it's got two completely independent features of it. The first one's condition. The second one's area. If you're talking about condition, that's how old is the building, how beat up is the property. And then, of course, luxuries and amenities. Is it really a no frills sort of place, or is it just fantastic and full of nice things that the residents will be happy to use? That's the condition. Whereas if you're talking about the area, excuse me, got a tickle in my chest here. But the when you're talking about area, if we're talking about residential, then crime rate is always going to be important. And then of course the school districts where the properties are located are going to be important. But after all, there's that old trope that brokers love to say of location, location, location. I don't think that that's very informative. What they really mean is traffic, traffic, traffic. If a gazillion people pass by a property every single day, it's going to be more desirable for that reason. It's closer closer to home and whatnot. But both the area and the condition, they are ranked the same way as in grade school, where you have A plus at the top, then it's A, then A minus, then B plus, and so on. So, Eric, as far as you and your group goes, what's easier to say yes to?
So I mean, we have started out in the portfolio looking at C class properties and C minus locations. The numbers can look really good, but the property management can be killer, and it takes a lot of work. So we've actually been shifting over time to focus on at least property in B class areas. And whether or not the property is B to C or whatever, we don't mind going in there and bringing it back up into an A, if not a B class asset. So we definitely think the location is significantly more important. And then in terms of geography around the country of where we want to invest, we've started making the decision that we're not going to buy property in areas we don't want to go ourselves. Right. It just makes it a lot easier for us to get down there and manage it and have people there to manage it and be a part of the management team if they're in locations that are desirable for us to travel to. Because we have owned assets that are in very inconvenient locations to get to. You know, it's like you have to fly into an airport and then drive 2 hours to get somewhere. Right. It's very difficult to access that property. So those are kind of the shifts we have started to make inside the portfolio going forward.
And then what about states?
Right now, the portfolio is in New Mexico. This is where we started. I was down there for 6 years while I was in the military. And then military also brought me back up here to the Denver metro area. And then we started buying here in Colorado. So those two right now, and then we just really like the Tucson market as well. We haven't seen a lot of deal flow happen down there. It's not as competitive as Phoenix. A lot of people don't want to go to Tucson, but you know, we're fine working in the markets nobody else wants to be in.
I love that answer. I love that answer. So then let's talk about people. My favorite thing, as a matter of fact, of being in the commercial real estate space, especially come from tech, you know, you get a lot of recluses, people who are not all that social, but, and they're also not generally willing to share a bunch of secrets or strategies, things like that. But in commercial real estate, because it's multifaceted, nobody's going to be all six sides of the cube for any meaningful amount of time. Everybody's going to focus on their sides, their roles. They're going to have like one or two different roles that they excel at, and they'll stick to that. But at the same time, because we all have our own unique skill sets, we're better off helping some people more than others, even though we're constantly making introductions and building new teams, even if we're not on them. Me personally, because of my digital background, the content creation, all the different things that I do, the sponsors and KPs have always been the people who I tend to need to meet more of, because they've already got a foundation, a business built together where a person like me can make a disproportionately large difference. Whereas when you're first starting out as a local or a repositioner, you need grunts who can put in 80 to 120 hour weeks, and that's not how I contribute the most. And then of course, everybody in this industry is ultimately in the business of deploying capital. So the financiers I'm also very eager to speak to. And then of course, like just being the internet guy, that means I also need locals as well. So I'm eager to meet anybody, but Eric, if you have any 506B deals, don't go mentioning them. I know that you're accredited already, so you're probably sticking to 506Cs, but who on the die, who's in the audience that you're most eager to speak to?
I mean, we're looking for people that have other deals out there that we could probably partner with on that, you know, just making those relationships, seeing what else is out there. Yes, I am a accredited investor because I run my own fund, but like you said, our fund's a 506B. But yeah, going forward, meeting people, seeing what other opportunities are out there, seeing how we can work together to take on deals, because not everybody can do everything at every single time. So, you know, it's so much better to work with someone, share a profit, take down a deal than nobody being able to take it on because they just don't have enough players.
I love that answer. And so people must be thinking, oh, wow, I got to know how to reach out. And so I'm going to sandbag that conversation and talk about myself. Luckily, I have a very distinct last name. It means that on the internet, it's very easy to find me, especially on LinkedIn, which is where I spend most of my social media time. So that's definitely where I'd like to connect. Of course, on Amazon.com, I have some books available on different things about business, creating skills, and attention to detail and real estate itself. But if you you are involved in syndication and investment, I encourage you to pause the video, scan this QR code. That goes to the FAQs page of 506BME, which is the platform where I offer the service of maintaining your investor list and all the documentation that we have available to make sure that if your laptop falls into the bathtub, then when the SEC audits you and needs to see that documentation in your substantive relationships, you're okay. And so that's what I'm up to right there. But Eric, if people want to reach out to you, social media, website, any of that kind of stuff, what are the best ways to reach out?
Yeah, so we do have a website, paragon-assets.com. All of our contact information is out there. People can also reach out to me via email. It's eric.bonick@paragon-assets.com.
All right, beautiful. And that brings me to the last thing. It's the public service announcement I always do, and it's not for you, Eric, it's for you and the audience. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that's just down there. You can get rid of it for free. And full disclosure, the reason why I want people to click on it is because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so that we're clear, it means that my videos may show up on your list of suggestions. It doesn't mean that they actually will, but quite frankly, you can go ahead and ignore those suggestions because I just appreciate the fact that you spent this time with me. Just like Eric, I appreciate you joining me. This has been great.
Yeah, thanks for the invite, Dan. Happy to do it.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.